Okay, many of the more successful quantitative strategies examine time series on multiple time scales. In electrical engineering, the discipline that I come from, feature detection and signal processing is generally performed in a multi-resolution decomposition, and features are determined as what persists across, features should persist across multiple time scales to be considered a meaningful feature. One example of this is we see multi-resolution decomposition to my eye. My understanding of markets is that technical analysis people have been using multi-resolution for years without knowing it with their multi-day moving average crossovers. 50-day, 100-day crossovers are actually when you're seeking for features that span multiple time scales. I'm sure they don't know that's what they're doing. It's a very natural thing for the human eye when we're gaining a sense of scale or scope to zoom in and out on a chart, and that's exactly what a multi-resolution decomposition does, is it basically zooms in and out on a chart to determine the scope and relevance of various features and patterns. Anecdotally, I was once interviewing for a hedge fund position, and I was asked, given a random instrument, random time series, not knowing what it was, what market it was, or anything like that, how would I trade it? I was pretty green at the time. I was kind of appalled at the idea of just trading a random instrument, and I thought that they might be messing with me. I told them that basically, at the time, I told them I wouldn't trade an instrument knowing nothing about it and having no information about related instruments or anything like that. Now I think if that wasn't correct, they were appalled at that answer. If that wasn't correct, today what I would say to that is that I would perform multi-time-scale, multi-resolution decomposition on it to determine self-similarity, and then go from there to determine what features are relevant and how to algorithmically take advantage of the modalities in the time series.